Yes, thank you everybody for joining us this morning. And my name is Pat Stone. I'm Executive Chairman and Founder of WFG National. And with me today is Dr. Bill Conerly. I've known Bill, I think, about 35 years. He was the economist for First Interstate Bank before Wells Fargo bought them. And got to know him over the years. We stayed in touch. I consider him a friend and also a mentor. Bill has focused on making economics understandable and useful for the business community. As you all know, most economists are very theoretical. You can never pin them down. You can never get a straight answer. I've always enjoyed dealing with Bill because he tells it like he sees it. And I get a monthly update from him and have for years. So he shows what's happening, what he thinks and why. So I thought it'd be useful to have a Q&A session. And we've got a lot of questions from a lot of people that we'll go through today. Please, I'd love your feedback and what you think as this goes, and we hope you find it useful. So I'm going to start out by asking Bill kind of a question about what he sees is going to happening the rest of this year. What do you see Q3 and Q4 of this year, Bill?
Well, Pat, you said most economists you cannot pin down. I may become one of those. It depends, of course, on what's happening with the disease. And my best estimate is that we're obviously in the down phase right now. I think that we'll have a sharp upturn, but not back to where we had been. So if you think of the V-shaped recovery, the first quarter began that, especially March. Second quarter is very much down in terms of the overall economy, consumer spending, home sales. But I think that we're going to come sharply up, but not as far back. So the V is sort of lopsided, and then we level off, because we're not going to have a sudden bell ring saying, hey, it's all clear, party like it was January. And then we level off. So it's like a square root sign, if you remember that from high school days. So I'm fairly optimistic that this awful period that we're in right now in May is not going to last terribly long, but we have to be cautious. The reopening will be state by state. But then I think third and fourth quarter should rebound a good bit, but not as high as we had been, and not as high as we would have been if things had continued. Does that make sense?
That makes sense. And, it's just a comment on that real quickly. When I get asked that question, I say tell people they articulate a lot of negative numbers, and I say, well, somebody turned the TV off. These numbers aren't really as relevant as they would be if this was a cycle, right? We're not here because we cycled down. We're here because they turned the TV off and there's no picture. So I don't know if that makes any sense.
And let me mention 2 points, and then I'm going to throw a question to you. But the first point is about there's always some normal churn in unemployment. People lose jobs, people get jobs, but this disease has triggered about a 19% loss of jobs relative to where we were and what was normal, which means 81% of the people still have their jobs. And those who are unemployed are getting checks, and some of them are hurting, some of them are better off collecting unemployment. So keep that in mind, that the economy is not just totally doom and gloom. But we had one of your clients send a question in. Let me hit you with that. With possible scenarios such as the virus coming back in the fall, no vaccine or treatment, or prolonged social distancing, with these possible scenarios, what steps would you take to ensure an agency's survival through to a recovery?
Let me start by making a quick comment to paint maybe a little bit of a background for thought process. I think we're, one thing that happens during a prolonged level of anxiety and uncertainty is you get to a burned out phase. And the longer it goes without clarity, the more likely you are to assume the worst. And candidly, we're being inundated with a lot of speculative comments and scenarios about what could go wrong. We don't see a lot of speculative scenarios about what could go right. And so I think anxiety is at a very high level, and we're sort of in a negative burnt out phase. And you're seeing it in people's behavior. People don't want any more information because all the information is negative. So I think it is absolutely appropriate to say, how do I survive if things go wrong? But look at it this way. Keep a positive attitude, because until they go wrong, they're good, right? Until they go wrong, you don't know what's happening. So first of all, it's absolutely essential that you maintain a positive attitude while you plan for the worst. Now, here's what I've already done. I've already figured out what I'm going to do if the market drops 10%, if it drops 20%, if it drops 30%, or if it drops 50%. I have a written plan in place for exactly how WFG will respond to any of those scenarios. And in the meantime, I'm very positive that it's not going to happen. Why do I do it that way? Because if I have to exercise those plans, I do it in a very emotional, very quick manner. Yeah. What usually happens is every single business person knows what they have to do. The successful ones do it quickly and unemotionally. The unsuccessful ones sit around and debate and anguish, and they feel all the emotions about it. It takes them way too long to respond, and they fail. So if I'm in your shoes and you're in the same shoes I'm in, we're in the same business, sit down and figure out a plan, write down exactly what you do to minimize your costs, what you do to adapt to a down market, and then maintain a positive attitude, because knock on wood, we won't have to confront that.
Sounds good.
Does that make sense? Well, Bill, so COVID-19, the path, what are your feelings that COVID-19 might come back for a second wave, and how will that affect the economy if we have to go back into social distancing? I've heard that it may take years to get out over this pandemic. What are your thoughts?
Yeah, so the medical question, I'm not that kind of doctor. PhD in economics, and at Duke, the medical school is 2 buildings down from the economics department. No classes on vaccines, but I've been reading a lot. And let me just give you a range that I'm hearing from people I find credible. If you're a pessimist, we don't get a vaccine or treatment anytime soon. And in fact, the scientists cannot guarantee that we will find a vaccine or treatment. The optimists, though, say this is the fastest response to a new disease in the history of the world. Scientists have more information, better tools. They're collaborating faster. There's a project out of England where they have an existing vaccine that they think they can tweak to make it work on COVID. They don't know yet. So the upside is really, really back to normal, and we'll have a wild New Year's Eve party with hugging and kissing. I'm making economic forecasts on a more tempered approach that says we have to stay partially social distancing through the end of this year and on into next year. If we go out to restaurants, I think every other table is going to be empty, so that we keep some distancing, that people who can easily work from home will continue working from home, but maybe go into the office once or twice. No big conferences, conventions, but there will be smallish meetings. And that's why I think in my economic forecast, we don't get back to where we should be until sometime next year. But I think that, Pat, it's wise to be aware of all the scenarios, the good side as well as the bad side. And when I started my career, I was doing a lot of presentations, and I found that people came out of my presentation optimistic or pessimistic, not based on what I said, but based on whether they were inherently optimistic or pessimistic when they walked into the room. And that's, I think, who the people in our audience are today.
Do you think, I'm going to kind of go off script here for a second, but I'm kind of curious, do you think the analogy of the Volcker recession, how quickly hiring occurred once that recession was over, do you think that's applicable here? Will we see a surge in rehiring?
Yeah, I think it'll happen fairly quickly. For low-wage workers, not until after July 31st, because low-wage workers get that unemployment insurance plus a $600 federal bonus, and they're better off. If you've been making 10 or 15 bucks, you're better off unemployed. But I think in August, there's going to be a surge, not at all like the last recession, not at all like 2008, 2009. I think there will be a sharp comeback. So let me ask you, we had another question sent in. Prior to COVID-19, some people believe the role of the realtor and the real estate broker would diminish or change with lower commissions, fewer realtors. What do you see the outlook for that business after COVID-19? Should title people continue to market to realtors the same way they have in the past?
Absolutely, but I would target the most successful realtors because they're the ones that will survive and continue to do business. Candidly, the role of the realtor has been changing progressively for a long time, ever since the internet got opened up access to the market. It used to be you needed a realtor just to be able to find which homes were for sale and to be able to see them. So we were getting to the point now through the internet that the bulk of home buyers were finding the home by themselves and then using the realtor as a concierge to help them execute the transaction. I think that what is happening because of the pandemic is that the most successful realtors and the most technologically enabled realtors are still showing homes. They're showing homes via the internet. They're doing a lot of things using the internet. But what I would do and what we are doing as a company is we are being very careful to target the top producing realtors and make sure that we're in front of them because they will be around. I do think the total number of realtors will shrink. How dramatically, I can't say, but I think there'll be a noticeable elimination of non-producing realtors. But the top producing realtors will still be there. They'll still be controlling business and they still warrant your attention.
Makes a lot of sense to me.
So, going back to the real estate outlook a little bit, Bill, what's the outlook for real estate this fall and early 2021 as the economy slowly gets turned back on?
Well, I'm going to stick with that kind of V with the not full rebound. Some of the potential home buyers out there have dropped out, but not most of them. So a lot of the people who lost their jobs were waiters, bartenders, maybe not a potential home buyer, but some of the people who lost their jobs were, say, restaurant managers, hotel managers who could have been home buyers. So I think we'll see a small fraction of the would-be buyers not coming back even when things clear up. But most of the people will be back, and people who want to change their circumstances, sell their house, still want to sell their house for the most part. So I think we'll get a strong rebound in number of closings when you guys can actually do a closing, a strong rebound in the number of closings, but not back to the level we normally would be at in a July or August.
Okay, I've been using the number that 90% of the home buyers will be back and capable starting in Q3. Is that a comfortable number?
Yeah, and 90%, 88, 93, something like that, maybe as low as 85, but I think the volume should pick up a good bit.
Okay, good.
So let me hit you with another one. How will COVID-19 affect borrowers who want to refinance or buy now, but may not qualify as lenders are making it harder with credit scores? Will the lenders bend once the height of the crisis is over?
Yeah, what's happened here, and it was really interesting to watch, is that financial conditions tightened dramatically with the pandemic. And that happens anytime there is an excess of uncertainty. And with the massive reduction in employment, basically the increase in unemployment, and we're talking, what, 33 million people in the last 7 weeks. Lenders have become very, very cautious because of that. And they do not want to be in a situation where they go to all the effort to generate a loan and then have it not close because a person loses their job or loses their income. So what lenders are doing is they have raised the underwriting standards fairly significantly right now. And then they're also checking DOI and DOE all the way right up to closing date. So lenders are being very, very careful right now. But as I think we reemerge from the shutdown and we re-engage, the lending standards will loosen because they won't be so worried about another 3 million people a week losing their job and spending a lot of time and effort on a transaction that doesn't close. The positive for us in our business is you're going to have a much higher closing ratio in the next couple of months because lenders' underwriting is much more conservative. So it's a short-term phenomena. I think rates will stay down much past the end of this current crisis, if you will. And so you will have a much more accommodating lending standards with low interest rates, and you'll see refis continue because of it.
Good. Well, you covered the interest rate issue.
No, I haven't. I'm going to ask you that one. What impact will government purchase of corporate debt have on the economy and long-term interest rates? Is the refi market currently sustaining us? How much longer can we expect it to continue? Do you think that interest rates will dip below 3% as a result of this crisis?
Well, let me first talk about broad market interest rates, things like treasury bills, treasury bonds. I believe they're staying low until the economy really recovers and the pandemic is over. So that means a vaccine or an effective treatment that prevents deaths for those who get it. So I'm guessing that's at least end of 2021 that interest rates for the general market are at historic lows. Mortgage rates have been a little different. And historically, and I say historically, last 10 years, 30-year fixed rate mortgages have traded at a fairly consistent spread over 10-year treasury bonds, but that spread has widened. And what happened was the treasury bonds went down, but the mortgages stayed fairly high. So what's up with that? I think that we could see a full percentage point drop at the max in 30-year fixed rate mortgages. And it probably has to do with Federal Reserve purchases of mortgage-backed securities. And the fact that the mortgage rates have not dropped all the way leads me to smell the Federal Reserve in there. Now, some of the low treasury bond rates is global investors wanting U.S. treasury bonds because we're a safe haven. You look at our deficit, you look at our leadership, and you're saying, why would we be a safe haven? But compare us to, France or China, and it's like, yeah, we look better than the other pigs out there. So I think that there's a good potential. There may be a reason why the Federal Reserve does not want to be more active in mortgage-backed securities and pull the rate down. But I think that the direction is more likely to change downward than upward in the next year and a half. So I would be fairly optimistic about some more refi possibilities. And we could find people who refied a couple of months ago saying, hey, at this rate, makes sense now.
Yeah, I would agree with you. And I think the Federal Reserve bought the mortgage-backed security. I mean, they were trying to be very positive and supportive, but what happened is they caught the lending industry a little bit by surprise. But for everybody's frame of reference here, most lenders will lock in a rate and then they will hedge in the market against that in case the rate goes up so they don't get hurt. If they give you let's say they give you a 3.2% rate and the rates end up going up and you've locked yours in, what they do is hedge so they can offset that loss. Well, the Federal Reserve came in and bought all those securities and they got creamed on their hedging, but that's over. That initial shock is over now. So I think we're getting back to a more normal market. I kind of agree with you. We have potential for downturn or downside on the rates because, again, as you said, historically 1.5 to 2 points above 10-year, and right now they're Right now, they're about 2.4 to 2.6% above 10 years. So there's some downside potential there.
Yeah, good news. We have a question that I know nothing about. One of the participants here says, India is not able to provide the cheap labor costs because they do not have the infrastructure to sustain a remote workforce. Are there other offshore sources for semi-skilled labor in meeting our production? And how do you see the presumed increase in production costs addressed by the industry?
Well, I'm going to tell you straight up, this has been a very, very active conversation, because our NTS unit we'll probably do around 35 to 40,000 exams this month. Quite a few of those for our agency network and as an outsourced provider. The cost to us right now has gone up about $2 a file because of that. We have found replacement sources, and we worked around it, but we do anticipate that the BPO firms and the overseas providers are going to be restructuring the rates as this thing comes down, and they're going to probably be doing some investment in backup providing and doing other things that will increase their costs. I do expect them to pass on a little bit higher base cost in order to ensure that they don't get clobbered like this next time. So I do see the rates on exams going up, but I'm going to tell you this. Most of the providers like our NTS unit have figured out a way to work around this, so they can't push the rates up very far, because we have alternatives, and I'm hoping that the rate increases won't be significant and won't be meaningful.
Good.
So I kind of hedged on that a little bit.
Yeah, you don't want to be pinned down any more than us economists.
Yeah, it's hard right now to get clarity on it, but I think we can get by it. We know we can get by it, so they don't have the leverage over us they would have if we had to shut everything down. Some providers, not our NTS unit, but some providers got hit pretty bad because they were totally reliant on offshore, major offshore providers in India, and they just got clobbered. So I think it's taught us all a lesson on a couple different levels, and I think we should all think about that. We've just gone through a major disruption, and I don't think anybody was 100% prepared for it or didn't have to react to it. So sit back sometime, take a couple hours and think about, well, what did you learn from this? What can you do different? What can you make sure you don't get caught surprised next time? I mean, there have been pandemics before, and there'll be pandemics or like-kind issues in the future. So we're thinking about it. There should be a lesson here.
And if I may jump in there, there'll be recessions, there'll be technological change in customer attitudes, new competitors moving in, changes in government regulations. So flexibility, being ready to change is, I think, a critical long-term business survival strategy.
Yeah, I would agree. Absolutely. It's a lesson we should have learned. We're in a highly regulated business, so we don't think about it a lot. We need to think about it because there's going to be changes, as Bill said. So Bill, I got another one for you here. Long-term impacts. What will the $2.5 trillion CARES Act have on the economy long-term? What impact will have it long-term? And could there have been an alternative, less massive response relative to the debt versus GDP?
Yeah, let me take this and combine it with what the Federal Reserve is doing. So the Federal Reserve did not get the big headlines because they didn't have $2.1 trillion attached to their name, but they're doing massive purchases of securities and financial markets, injecting a lot of liquidity into the system, helping bring interest rates down, as we discussed. And the two things, the fiscal stimulus of the CARES Act and the unemployment insurance and PPP and all that stuff, which is, I think, getting close to $3 trillion. And the federal government had planned on spending like 4.5. So you take a plan of 4.5 and you add 3. I would call that a budget variance if I were back in my corporate days. So you take the fiscal side plus what the Federal Reserve is doing, and we've got a lot of dollars in the economy. And at the same time, we have a lot of dollars in the economy. Our productive ability is challenged. We've got some plant closures because the COVID virus went through. Of course, you've heard about restaurants and amusement parks. The classic definition of inflation is too many dollars chasing too few goods. Well, we've got a lot of dollars and we've got fewer goods and services in the economy. So at some point, I believe we're going to get inflation. And I've not been the person crying wolf about inflation for the last 10 years, but I'm starting to fear that. Not in 2020, not in 2021 even, but on towards 2022, I think we'll see inflation edge up. And, not getting to the high levels that we saw in the 70s with 10% inflation, but I think it's going to be edging up. And at that point, some market participants, financial market participants will say that they ought to be compensated for lower purchasing power when they get repaid. So that'll push interest rates up. And if the Federal Reserve sees interest rates going up, I think the Federal Reserve is going to start tightening. And I think that we're a couple of years away from a very different economic environment, one where people start thinking about inflation and interest rates are rising.
So is it fair to say that you would be against any more tariffs that disrupt the supply chain then?
Yeah, we economists are pretty much all against tariffs aside from one or two. And, the part of that question was, could we have done it differently? Yeah, we could have done it differently. I would have done it differently. But, things are changing so rapidly that people making decisions are doing the best they can with limited information. And in a normal year, I would be criticizing the bozos in Washington left and right, but they've had a tough job, and I'm just going to withhold second guessing their issues.
Well, I'm going to make you second guess something, so I don't know if you share this, but I'm personally very concerned about us getting some support for state and local governments because their revenue base has been killed. And I got into an argument with a fairly conservative friend of mine the other day, and he says, no, we shouldn't bail them out. And he said, Mitch McConnell thinks the states should go bankrupt. Well, I said, where do you get your water? Where does your sewage go? The roads you drive on, who pays for all that? The state and local governments. And are you as concerned as I am on that area?
I'm not as concerned as you are, but I understand the concern, and it does make sense. And I'd do it at a base level, so you're not rewarding those states that have been irresponsible for years and years. And if I name states, I'd probably insult somebody in our audience. Well, we've got about 1 minute left. Pat, you want to make some closing comments?
Well, yeah, and I was thinking about talking about the WFG Blocks program when I responded to your first question about what people should do and how to plan for a downturn. I'm going to encourage everybody here to think real seriously about what functions in your operation you can outsource. Now, whether you use the WFG Blocks program or somebody else's outsource, think about it anyway. And this is not a sales pitch. This is for you to think seriously about what functions that you conduct are actually client-oriented and are brand-related, and what functions have no brand equity and that you could outsource and eliminate costs and reduce your expenses. I think it's time for you to really think seriously about this. This business evolved with everybody doing everything. I don't think it's sustainable for the title industry to have duplicative efforts at every level. So take a look at what you do, see what you can outsource realistically and sustainably and lower your costs. If you'd like, talk to the WFG rep about our Blocks program. Also would encourage you to talk to our MTDs about technology and getting prepared for a more digitized mortgage process. I don't think it's going to happen overnight, but you're going to see more and more pressure to be able to conduct your business in a digital manner. So we have MTDs that will help you. We have a Blocks program that will help you. Take a look at how you can do these type of things. Bill?
Yeah, and if we I know there are people with more questions than we could handle in this 30-minute time horizon. People can communicate with WFG through their representatives and pass some questions on. Maybe we can find a way to get those questions answered. You're welcome to reach out to me directly, Bill Conerly. Take your best guess at how to spell it, and Google will find me. I'd be more than happy to share my thoughts. Yeah, one in.
All right. Well, thank you. Thank you, everybody. Thank you, Bill. And let us know if we can help you.
And thanks to WFG for sponsoring this.
You bet.